Hi, I'm Julia Cockcroft and I'm a Senior Associate in the Bristow's tax team. The purpose of this short clip is to provide an overview of two related tax reliefs that can greatly improve your small or growing company's chances of obtaining equity funding from UK tax-paying individuals, particularly angel investor networks. These reliefs are the Seed Enterprise Investment Scheme, that I'll refer to as SEIS, and the Enterprise Investment Scheme, or EIS. And they are particularly popular methods of attracting funding for tech startups. So how do the reliefs work? They incentivise individuals to make what would otherwise be fairly risky investments by offering tax breaks that effectively reduce the amount of the investor's capital that is actually at risk. The purpose of the reliefs is to plug a funding gap that exists for small and growing companies, those companies that generally speaking would find it difficult to access other forms of finance, such as traditional bank lending. The two reliefs are effectively sister reliefs. SEIS applies to very early stage companies with less than 200,000 gross assets, and it is an exceptionally generous relief. EIS relief is not quite as generous, but it's still very valuable, and it's available to a much wider range of companies with gross assets of up to 15 million. The idea is that a seed stage company can raise initial funding using SEIS and then move on to raise funds under EIS as it grows. The tax breaks are available to investors, so not the company that's being invested in, and they are very generous. There are broadly three main tax benefits available to an individual making a qualifying EIS investment. The first is an income tax relief, where an investment is made in an into SEIS qualifying shares. Up to 50% of the amount invested, so up to an annual individual cap of £100,000, is available as a deduction from the investor's income tax bill. So that's a maximum tax saving of £50,000. The percentage relief is reduced to 30% under EIS, but the annual individual investor limit is £1 million, so there is a maximum £300,000 tax deduction available under EIS. The second tax break is a capital gains rollover. If an individual has sold assets that have triggered a capital gains tax liability, the proceeds of that sale can be reinvested into SEIS or EIS shares. Under EIS, the gain on the other asset is frozen until the EIS shares are sold, which gives a valuable tax timing advantage to the investor. Under SEIS, 50% of the gain that can be reinvested can be permanently exempt from tax. Finally, and importantly, there's no tax on sale. So when qualifying SEIS and EIS shares are sold, the proceeds of that sale are exempt from tax. There is also a special loss relief available on SEIS and EIS shares, which improves an investor's tax position in the event that the investment is unsuccessful. The combined effect of all of these reliefs is that when an individual subscribes for SEIS shares, the actual amount that the investor stands to lose can be as little as 27.5p in every pound. For an EIS investment, the amount at risk can be as little as 38.5p in every pound. I'm going on now to outline some of the detail in the SEIS and EIS rules. One of the biggest problems with the release is the level of complexity in the rules, particularly given that they're designed to assist small enterprises without deep pockets to pay for professional advice. In order for investments to qualify for the relief, a number of conditions need to be satisfied, and those conditions relate to the company and the nature of its activities, the shares themselves, and to clarify, the reliefs are just available for shared subscriptions, so loan finance, including convertible loans, won't qualify. Finally, the investor himself or herself must meet a number of conditions, mainly centred around the individual not having a significant connection with the company. In particular, the investor can't hold more than 30% of the share capital in the company that's being invested in. A company in search of funding should consider the qualifying criteria and, where possible, take steps to ensure that they can be satisfied. It's possible for a company to obtain advance assurance from Hmrc that it qualifies for reliefs before investment is raised, and this can be a particularly useful tool in securing investment. Crucially, the company must carry on a qualifying trade, but this can include research and development activities. Whilst most trades would qualify, there are a number of excluded activities. These include lending and other similar financial activities, certain advisory businesses such as legal and accountancy services, and IP-based businesses where the IP has been brought in rather than developed in-house. There are also exclusions for significant asset-backed trades such as property development and dealing, amongst other things. A company may fail to qualify if it carries out any activities that consist of excluded activities to any significant extent, or if it has any significant investments over trading activity. There are other company criteria to be aware of, so the company must be independent, meaning it can't be controlled by any other company, and it must have a presence in the UK. There is also a maximum company size threshold, and that size threshold applies to gross assets and the number of employees that the company has. And there is also a company age limit test. So what are the common pitfalls when securing SEIS and EIS relief? The EIS shares need to be held for a minimum period of 3 years in order to enjoy the full range of tax breaks. If disposed of before then, the reliefs are either simply unavailable or withdrawn in whole or in part. A number of the detailed EIS rules need to be satisfied both at the time the shares are subscribed for and the duration of the 3-year holding period. Companies can often cause problems for their EIS investors if they take any actions that cause the EIS conditions to be breached during the 3-year period. For example, if they issue shares to a controlling corporate shareholder, which would then cause the independence test to be breached. It's also crucial that the share subscription arrangements do not contain any provisions that effectively protect the individual's investment. For example, provisions that guarantee any kind of particular return or guarantee a secured exit. Certain influential investors may need reminding of this when they're negotiating provisions to go into the share subscription agreement, but still expect to obtain SEIS and EIS tax reliefs. To round up, I'm just going to mention a couple of notable recent SEIS and EIS developments. The recently enacted Finance Act 2018 has introduced a new provision into the SEIS and EIS rules known as the risk to capital condition. This is a broad provision designed to narrow the availability of EIS and SEIS schemes to those companies that need it the most, being those companies where the funding that's being raised is genuinely at risk. The wide scope of the new rules is causing a little bit of uncertainty in the market, but Hmrc has issued some guidance outlining when they would expect the risk to capital rule to come into play. Also, a couple of years ago, the concept of a knowledge-intensive company, or KIC, was introduced into the rules. The relevant provisions are very detailed, but essentially those companies engaged in innovative IP-rich work may be KICs and could then benefit from extensions to numerous thresholds within the conditions, making them more generous. For example, the company size and age limit thresholds and investment limits are increased. And also the recent Finance Act has also introduced some further more generous rules that apply specifically to KICs. Finally, a practical point, it's worth noting that the availability of Hmrc's Advanced Assurance Service, so where pre-approval is obtained for qualifying investments, is in the process of being scaled back to some extent. There have been some well-publicised resourcing issues at Hmrc, and they're essentially no longer prepared to provide assurance for speculative SEIS and EIS applications. A company will now need to specifically identify its prospective investors in order to get approval from Hmrc. If you'd like to know more information on SEIS or EIS reliefs, or would like to find out more about how Bristow's can help you to raise finance using these regimes, please do get in touch.